Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Imagine you are at an auction. A painting worth 1 crore goes under the hammer. One person bids 1.1 crore, another says 1.2 crore. Soon, nobody is asking what the painting is actually worth. They're only asking one question: who's going to pay even more after me? That's exactly how bubbles begin. And according to billionaire investor Terry Smith, something similar may be happening in today's stock market. If there was ever a poll to decide the Einstein of money, Jack Bogle would almost certainly make the shortlist. Back in the 1970s, he came up with an idea so simple that most people thought it was crazy. Instead of trying to beat the market, why not simply own the market? His reasoning was brilliant. Study after study showed that most professional fund managers fail to beat the index over long periods, and even those who do often lose much of their advantage after charging high management fees. So Bogle launched the world's first index fund. At the time, critics laughed at him. One investment executive even called it un American because it was satisfied with average returns. But history had other plans. Today, passive funds manage trillions of dollars. In the United States, they now own almost half of all mutual fund and ETF assets. Millions of investors have built wealth simply by buying low cost index funds and doing nothing. It may well be one of the greatest financial innovations ever created. But here's the interesting part: sometimes a great idea becomes too successful. Let's understand why. Imagine there are only 10 shops in a city. Every month, thousands of people receive their salaries and automatically spend most of their money in the biggest three shops. Not because those shops became dramatically better, not because their product suddenly improved, but simply because they are already the biggest. What happens? Those shops become even bigger. Their prices keep rising, and because they are now bigger, even more money automatically flows towards them next month. It's a self reinforcing cycle. Something similar happens inside index funds. The bigger a company becomes, the larger its weight in the index, which means every new rupee entering an index fund buys even more of that company. This isn't necessarily wrong, but it can become dangerous if investors stop asking a very important question: what is this business actually worth? That's exactly the concern Terry Smith raised in his latest shareholder letter. He believes the excitement around artificial intelligence combined with the relentless flow of money into passive funds has created an unusually strong momentum. As more and more money chases the same handful of giant companies, their share prices can rise much faster than their underlying businesses. Now, notice something important. Smith is not predicting a market crash. He openly admits he has no idea when sentiments will change. He is simply reminding investors of an old lesson: price still matters. History is full of examples. During the dot-com bubble in 2000, companies with no profits were worth billions. In Japan during the late 1980s, the land underneath Tokyo's Imperial Palace was famously said to be worth more than the entire state of California. In 2021, many meme stocks and cryptocurrencies soared simply because everyone else was buying them. Every cycle has a different story. The asset changes, the excitement changes, but investor behavior never really does. That's why the world's greatest investors always had boundaries. Warren Buffett refuses to buy businesses he cannot understand. Peter Lynch insists on knowing exactly how a company makes money before investing. Terry Smith looks for exceptional businesses but refuses to pay absurd prices for them. Different strategies, same discipline. None of them believe that any asset should be bought at any price. And that's where the irony lies. Jack Bogle created index investing to remove emotion from investing. He wanted people to stop chasing hot tips, stop timing markets, and stop overpaying fees. But if investors start believing that an index fund is automatically worth buying regardless of valuation simply because it's an index, they may end up making the very mistake Bogle spent his entire life trying to protect them from. So, the lesson is not that passive investing is bad, far from it. For most investors, it's still one of the smartest ways to build long term wealth. But even the best investment strategy in the world becomes risky when people stop thinking about value. Because in investing, there is one rule that never changes: a great asset can still become a terrible investment if you pay too much for it. Think about it. Well, that's all from me today. I'll see you again in the next session. Goodbye and happy investing.